Well, hello and welcome to Finding Alpha, the show where we zoom out to understand the macro and then deep dive into the micro. All of this to sharpen your stock selection process. Well, today we'll be focusing on a very crucial theme. Who stands to gain amid the rate cuts and asset quality concerns? With the RBI shifting to a pro-growth stance and introducing a series of rate cuts, albeit modest, investors are weighing this against tepid credit growth and some signs of emerging stress in asset quality. Well, to unpack this, we're now joined by Digant Haria, founder of GreenEdge Wealth, a firm that builds tailored stock and high-yield bond yield portfolios. Digant, by the way, has been tracking India's banking and NBFC space for over 16 years and brings a sharp lens to what matters and what doesn't in this dynamic sector. Well, Digant, thanks a lot for coming down to the studio. And we're looking forward to learning more about, the financial companies, NBFCs, and some HFCs as well. How are you feeling about the sectors right now?
Thanks, Nigel. Pleasure to be here. Pleasure to be on the first show of, the first episode of this new series. So yeah, I think, banks, NBFCs, it's a very large sector. So always there's interest. And the reason for a higher, a higher scrutiny for this sector now for investors is, the RBI started reducing the regulations and they have cut the rates. Yeah. And there's a finance minister who said that NBFCs should not think of themselves as shadow banking and they should now go out and grow. So the government and the regulator wants this sector to grow. Which is the reason why we are all looking very closely where in the large space can we find our growth.
All right, Digant, then let's take that forward and let's focus first on the housing finance companies, because it's more relatable as well. Now, housing finance companies within that, some of them could see some margin expansion, as you said, because of the rate cuts. Lower cost of funds will help them. There's also backed by physical assets, which is good in terms of asset quality. And within housing finance companies, well, we'll break it down into traditional housing finance companies and affordable housing finance companies. First on the traditional lot, and we'll get those graphics up for you on the screen, the likes of LSE, Housing Finance and the likes. Yeah. Anything you like out there? Is there one of those companies that is better placed?
Nigel, I think, traditional housing finance companies, you highlighted a lot of positives, but then, all these positives come with very high competition. All private banks, all PSU banks, all regional banks, everybody wants to do affordable housing, and which is why the margins and growth both will be under pressure for this segment. So this is a segment which is best left for, somebody who's happy with 10% returns, because I don't see, a big upside in any of the stocks in this particular sector. I think if somebody is still very keen, maybe Canfin Homes has a little bit of turnaround story left, but otherwise I think best to focus on smaller names, niche names where banks cannot really come and compete.
So we'll keep the traditional housing finance. They're not giving you anything to really be very excited about. But let's focus on, the other ones. That's the affordable housing finance companies. And when we talk about real estate companies, their advice is always go with the larger names. But I believe from this space, you are looking actually a smaller name from the affordable housing finance. India Shelter, that's the one that's on your radar. I think it's well placed, though the loan book is the smallest, but the ROA is looking quite good. Tell us more and what's the rationale?
Yeah, so I think, the affordable housing story of India, a lot of times we say there's so much opportunity. Actually, that's not true. The opportunity is limited in affordable housing because all the housing prices have gone up. So in housing finance, we have one rule, Nigel, that you focus on companies which are small in size, because the moment you hit 20-25,000 crores in loan book is the moment where either your growth or your asset quality starts suffering. We have seen that with Gru in 2016, Canfin in 2018. These were also great affordable companies at one point in time and they're struggling later on. We've now seen it with Awas and some extent Aadhar also. So this is a space where I think smaller is beautiful. And I think amongst the small space, there is Aptus and there is India Shelter, which is like less than 10,000. Between the two, I think India Shelter has a better growth focus and better prospects of growing and maintaining their profitability. So I think that can be a business which can do well over next 18 months.
Yeah, and as you said, I think the loan book is less than 10,000 crores out there, but it gives you a good potential to grow. Just wanted you to highlight, what about the LAP exposure for these companies? How much is it?
Okay, so that is slightly, like we say these are housing finance companies, but anywhere between 25 to 40% of their portfolio is in loan against property or LAP, as we say. It's a slightly risky segment, but that is what gives them margins. These players over the years have really done it well, but there's a little bit of risk build-up. So you always have to be careful and not go overboard because, mind you, Nigel, these are all trading at 3.5 times price to book also. So they need to execute well. I think India Shelter over last 2 years, they have had a new management from Chola and I think they're doing things right. So I think that is where we have the best probability of success. But yeah, we have to be careful about LAP.
Pick up the pack, India Shelter from Digant there. Loan book size relatively smaller, but they've got triggers. And that's why Digant says that they're favorably placed. Digant, I wanted to ask you about the asset quality. On the asset quality side, particularly in various pockets, MSME, 2- and 3-wheeler space, there are suddenly some signs of some pressure. Right. For the sector on the whole, how are you reading it?
Yeah, so see, I think the pressure is in the high yield lending space. Like if we break down the entire lending space, the pressure is in the high yield lending space. So you look at microfinance, you look at personal loans, you look at unsecured business loans, and lastly, you look at these 2-wheeler, 3-wheeler loans. So these are all places where you lend at more than 20%. There is a stress. The stress is not come today. It is building up since the last 18 months. Yeah. I think another 6 months and we will find our feet. So it's not something which is alarming to me. I think we have already seen bad patches. We are about to, end those bad patches in coming quarters.
Yeah, that's heartening to hear because let's turn our attention then on the vehicle finance companies itself. From that space, HDB Financial, well, it recently listed. And those that bought in the pre-IPO would be a little bit worried, because the IPO came actually attractively priced. Okay. Now, going at the current state of affairs and, the valuations that it trades at, what's your view on this name, HDB Financial? If you compare it with the traditional darling, that was Chola, always got the best in terms of valuations. Right. Out there, between the two, good pedigree, good parentage, what's your pick? How would you approach both these two names?
Yeah, I think, see, Chola, there is very little to complain, but the macro setup is really we were at the best possible scenario for the last 3 years. Good truck prices, good number of trips. So everything was going good. I think after 3 good years, we have a high base and, we are slowly decelerating. So somebody like Chola, who has seen amazing valuation expansion, amazing returns, I think that should rest now. The best days for Chola as a stock, maybe 1 year is a time of consolidation for Chola, maybe even a little bit of correction because it has run ahead in terms of valuations, around 5.5 times price to book. HDB Financial, on the other end, it has struggled over the last 2 years in terms of asset quality and operating costs. But I think if cycle improves, which is our thesis of this show, that, the lending cycle will improve in the next 4 quarters, I think HDB Financial can meaningfully outperform Chola. Not to say that, these are like small caps who can go up a lot and something like that. But between the two, I think the funds may actually end up shifting from Chola to HDB if HDB shows a little bit of execution. All right. So, and HDB is much more cheaper. So
absolutely, as that chart is telling you, HDB is still relatively more attractive priced if you look at it against Chola. So we take that on board. And in the near term, you would say, if someone is looking at a fresh investment, you'd rather pick HDB over Chola for the reasons that you've given. What about Shriram Finance? It was attractive. Then it became even more attractive, made its way into the Nifty, and it's a frontline name. Valuation cushion, but what is your view on the stock?
I think Shriram has also done really well. If you look at last 3 years, it's done better than Chola also, which will come as a surprise to a lot of the observers of this space. But I think, see, Shriram should also rest. Just like Chola, I think Shriram should also rest for some more time. Their numbers, we are at 3.5% ROA. So, when you are at a high base and the environment is not very favorable, you may not show very strong earnings growth, and stocks typically don't do well. It's a great business model, great company. But I think, you will get better opportunities after 6 months or 9 months.
Okay, let's talk about then. So Shriram, Chola, maybe a bit of a rest. HDB Financial is something that could relatively better place. But let's talk about a stock actually that's done very, very well. L&T Finance, the stock is up, I think, close to 50% in just the last 8 months or so. It's re-rated a fair bit. But since Mr. Sudipta Roy, since the time he took over, there's been a lot of good news that's coming in there. And we just spoke to them actually. They said that they'll grow by 20-25%. That's good. But they only cautioned that the MFI industry, that recovery could be pushed back by a quarter. Your view on the stock, it's already seen some part of re-rating. Is it getting started, or is the best already in the price?
Okay, so yeah, so see, they had this turnaround 3 years back when the new CEO joined. He changed the way credit is done, especially in two-wheelers and tractors. So I think that turnaround will be visible, from say next quarter or Diwali. And microfinance, as we say, is a pain for everyone.
Yes.
But if you look at the comparative charts, the pain for L&T Finance, Ujjivan, and Credit Access, these three companies, it has been the least. So they have been the best three out of the 40 microfinance companies. So I would think that this is one place where you have a large name, comfortable valuations, and good potential, combination of all three. So if somebody is looking at the larger blue-blooded names between, say, Shriram, Chola, Sundaram, Mahindra Finance, L&T, I think L&T is a hands down can be a better performer than the other large names.
But the only point is, after the recent run, it's not that cheap compared to what it was. That said, what would the fair multiple you would give it, for L&T Finance?
So see, L&T Finance, all other diversified large groups, who have corporate backing, they're trading at 3 to 5 times price to book. This guy is at 2 times.
Yeah.
Obviously, it is because the ROEs are at 11-12%. I think as the ROEs re-rate, which they should over next 18 months, I think the valuations also have room to expand. So you have a 20% room to expand in terms of valuations, and then earnings compounding is what people can earn. And in absence of all other ideas, a lot of money can flow. So valuation expansion can be a bigger game as well, which we cannot predict today. But if Sundaram, Shriram, Chola, do not attract money, the money is going to flow somewhere else.
Well, Digant, so that's about the vehicle financing space. But I think the space that gives you some comfort is with the way gold prices have moved up. These gold finance companies actually could be pretty well placed. And also the commentary that's coming from the RBI, particularly in the last, I think, 10 to 12 months, has been favorable. That said, just give us a couple of basic numbers first. What is the size of the opportunity out there? How much of it is unorganized? How much of it is organized? The split between organized and unorganized?
Okay, so see, credit card, people like us, we get credit cards. We can just go and swipe whenever we want. Gold loan is sort of, a credit card for the businessmen and credit card for the poor. Whenever you need emergency loans, you pledge your gold, you get the loans. It is no more a distress loan in India. It's not as if when I don't have anything and there's emergency. So it's like a business loan. So instead of playing a personal loan company or a business loan company, gold loan is a preferred bet. That the overall industry is very huge. More than 15 lakh crores is the total industry size. But half of it is controlled by money lenders. Money lenders charge 36 to 40% interest rates. And it is almost criminal. Those rates are so high that, I think these NBFCs charge between 14 to 19%. So they have a very good case. The banks generally charge between 12 to 16%.
Okay.
So that is the spectrum. I think this is an industry which is growing because, one, gold price is extremely favorable. 2, the regulator has streamlined the guidelines, and the guidelines are actually in favor of the sector growing faster. And 3, you have more and more players who are coming in the gold loan industry, like Poonawalla is starting with 400 branches, L&T Finance acquired Paul Merchants, and so on and so forth. So when everybody markets gold loan, the industry itself expands.
Okay.
And when personal loans and microfinance loans are not easy to get, gold loans is something which shines.
And this 15 lakh crore, as you said, it's divided into 50% each of them.
Organized and unorganized.
So for the industry, what kind of growth rate are you working with for the organized sector?
So Nigel, I think these numbers may sound insane, but 20% is a bare minimum growth in gold loan industry, which we can see this year. That is when our credit growth is going to be 9-10%. So it will grow 2x that of the system. And because of all the 3 factors which I just highlighted before. One factor which every investor has to keep in mind is you have to keep your eye on gold price. If there's a big crash in gold price, then gold loan companies cannot do well for 6 months. That is a patthar ki lakir, or what do you have to say? It's a very big thumb rule.
Okay, all right. Muthoot, that's been the big daddy, right? It's always enjoyed those premium multiples in the space. But that's what could limit the upside. Instead of Muthoot, would you rather play the other ones that can now twinkle? Say a Manappuram that's got new ownership, or an IFL that's coming out of a ban. Yeah. So among these 3 names, at least, what do you like?
So I think there's a spectrum. Each kind of investor can pick what they want. Muthoot Finance will probably do the best because it is best suited to capture all the growth. But Muthoot Finance probably more for the large funds, for people who are happy with 15-20% kind of returns. For people who want to play a recovery trade, I think IIFL has a wonderful gold loan book. They will show you the sharpest upsurge in growth because they had an RBI ban and so on. And there's one more interesting company called FedFina, which is a subsidiary of Federal Bank. I think that is something which got listed a year back, slightly undiscovered by the market. And, to your surprise, in gold loans, we look at what is your per branch AUM. So Muthoot is number 1 with 21 crores of gold per AUM. Number 2 is FedFina. It is not Manappuram. It is not IIFL. Number 2 is actually FedFina. So, FedFina, IIFL are interesting. Manappuram, the new CEO is about to join. They have some more pain in the microfinance. So, maybe I'll wait for a quarter or so for it to settle and then we can move ahead. But these gold loan companies are really better placed than the personal loans, companies like say Bajaj, Poonawalla section, which will come to the next.
All right. So in terms of preference, maybe Muthoot will not shine as much from now on. It could be a compounder though from here on, but the delta could come in from companies like FedFina and IIFL as well as a Manappuram. Well, you spoke about some of those consumer-facing finance companies. I'll tell you what. We'll slip into a short break. We'll come back and we'll continue the discussion. Digant will tell us what's his view on a few of those names as well. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha on CNBC TV 18. Well, we're still in conversation with Digant Haria. Digant, we have discussed a few themes, but as promised, we're going to be moving now to the diversified consumer lenders. Bajaj Finance, that's been the poster boy, right? If you ask anyone in 15 years, where did you make your money? They would say Bajaj Finance. The problem is now that the numbers, even when they're good, people want more. Ye dil mange more, right?
Yeah.
Do you think Bajaj Finance has run its course? Or can it give, I don't know, maybe a mid-teens, double-digit returns from here on?
I think it has run its course. It's very, it's a very harsh statement to make, but I really think that it has run its course. If you look at last 9 years, the stock price CAGR of Muthoot Finance has been higher than Bajaj Finance. A lot of people don't know this, but this is the reality. See, Bajaj was a leader in physical world, buy now, pay later. You go to a shop, buy a TV, buy this. Now shopping has moved online and Bajaj is no more the leader there. So Bajaj, the main reason why Bajaj is struggling is it is no more a leader in any fastest growing segments. So Bajaj has been moving to different segments like gold loan, micro loan, tractor loan, everything which is traditional. Bajaj never did traditional stuff.
Yeah.
But now because they are not able to grow, I think they have reached a size that unless India's middle class and lower middle class does well, Bajaj cannot really outperform. So Bajaj's outperformance is now so much linked to what happens to the entire middle class. It can no more outperform the country in a big way. So I think we can, personal loans, MSME loans, two-wheeler loans, the credit card loans, they're all struggling. And, which is why, apart from Bajaj Finance, we should also be very cautious on companies like, say, an SBI Cards or companies like Poonawalla FinCorp, which are talking of very fast growth in such an environment. I think these are places where investors will have to wait a lot before they can see returns.
All right, so Bajaj Finance and Poonawalla FinCorp, for the time being, you would not be, looking to jump into it. But I want to ask you about SBI Cards because that's the only listed credit card player, right? Credit costs remain elevated. Every time, there is something or the other, and now the best is yet to come, it doesn't come. Even, the past quarter's numbers haven't been that impressive. So asset quality is an issue, credit costs go up, growth is not coming about, they're not making any big dent in any market share. What's your view on the stock? Because if you look at rank underperformers, this is one stock that comes to your list.
I'll just give you one line, Nigel, that in credit cards, if you want to make money, you cannot sell credit cards at petrol pumps, at malls, at railway stations. If you do it this way, you invite a customer segment which is not very strong and which is why your asset quality issues never end. So 2021 to 23, their sourcing strategy itself was, you go much lower down the pyramid. And which is why you see quarter after quarter losses come and management is clueless.
Okay, all right. So that's aside. But JM Financial, that's something that you've liked. What's it? What's happening out here? Does it have more legs?
Yeah, so it's a capital market play. And if you look at this stock, 2008, the price was same as it is today. So it's almost 16 years. The company went through a lot of pain in the NBFC space. They have come out of that pain. So I think good times for the company are just about starting. It will be a very interesting capital market play to track for the next 2 years, because it's like a long 7-8 year of pain which is coming to an end, and capital markets division is doing very well. So instead of a mutual fund stock or a broking stock, we prefer something like a JM Financial, where there is a lot more steam in the business.
And it's got valuation comfort as well, even after this big run. So that's something that you like.
Absolutely.
All right, let's wind this down then by turning our attention to the micro lenders. Companies like Credit Access, Arman, they have what, 70 to 90% in this space, and they appear well placed. Do you like any of these two?
So see, microfinance is always cyclical. No matter what anyone tells you, there is a good cycle, there's a bad cycle. Right now, we are going through the deepest point of the bad cycle. Maybe in a quarter or two, from the deepest point, we'll start the upward journey. So if somebody is interested in playing cyclical stocks, I think this sector offers upsides. The best companies, the best managements are Credit Access and Arman in this space. But we feel that microfinance, even in the upside, it will be a little slow because that over leveraging was just too much. So in this space, we like something else, which is Northern Arc.
But tell us more about this Northern Arc, because there was a pending large trade. It took place, got cleared out around 200 rupees. From there, that has been one of the biggest outperformers from the broader markets. So at around 260 ballpark, what's your view on this name?
Okay, so...
And what are the key triggers you'll be tracking on this one?
Perfect. So see, Northern Arc is a very unique company. They lend to 300 other NBFCs. That is their first business. Second business is they lend to small LAP, microfinance, just like, a lot of other companies, say SBFC or, 5-star would do. So they have these two major businesses. One of the business, which is microfinance, had some trouble, and which is why the stock is trading at 1.1, 1.2 times book. I think the base business is so strong that once the microfinance down cycle is over and the up cycle starts, this will also re-rate quite significantly. So in Northern Arc, I see that there is a reasonable room, just like JM Financial or FedFina. There is a reasonable room for the business model to outperform in terms of earnings. So that is our business case in Northern Arc.
Northern Arc and JM Financial. But before we wind down, we had a couple of stocks on the screen, SBFC and 5-star business. They traded around 4 times approximately. What's your view on these two names, or are you going to give us an alternate?
See, I think both are into that very high lending space and they're growing fast. So this is an area which I try to become a little cautious, that high yield and fast growth. There's a chance of mistakes. Valuations are also very rich, so there is no margin of safety. So I think gold loan companies in this environment, investors are better off being in gold loan companies than in these companies. Maybe once the environment improves, we can do a shift trade. But
all right, Digant, it's been a pleasure having you on the show. Thanks a lot for joining in, explaining all of that to us. Just to rewind, India Shelter, something that you like. From the gold finance companies, FedFina, something that you like. And from the other stocks, Northern Arc, JM Financial, they could still look from here on. And that trade you spoke about, maybe it's time for Chola to make way for HDB Financial. It's been a pleasure having you on the show, Digant. We look forward to chatting up with you soon.
I'll just say one thing, that investors need to be patient. This whole cycle, it will take 2 or 3 quarters for the cycle to really turn around. And be long-term, track the businesses, not the stock price. And whatever we spoke is business analysis. That's it from my side.
Well,
thank you for having me.
Bang on, Digant. On that note, though, we'll wind up on this edition of Finding Alpha. Thanks a lot for joining in. We hope we managed to dissect the entire space for you. More news and updates coming up on the other side.